I'm Doug MacKenze.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Hey, thanks for signing in and listening. Really appreciate it.
First, John, everything good?
Everything's good. Thank
Excellent.
you. How about yourself?
Everything's going just fine.
Yeah.
Just fine.
Yeah.
Life is chugging along. Yep.
Everybody's...
We have more things that we want to talk about, believe it or not.
Yeah. Hopefully, it's always good, right? So here we go.
Even if not, we'll just talk.
Yeah, we'll talk anyways.
We like to talk. We talk a lot anyways, so we figured we record it.
Yeah.
And then, we're going to talk today about something very important, right, John?
Yeah, I think it's probably the most important thing to understand before. Why would you even bother moving on if you don't understand this thing that Nelson calls the very first principle? The very first principle to understand, and of course, talking to perspective and to clients, I say the gist of infinite banking is that you finance everything that you buy. And I probably shouldn't, I should ask people, does that make sense to you? Or any thoughts on that statement? What struck you when I said that? But I kind of preemptive going, people probably think that sounds crazy. No, I don't. I don't finance everything. I pay cash sometimes,
Sure.
And
I would have thought, I would have said that sounds gimmicky or that doesn't make any sense. You know what I mean?
Okay. Yeah.
Well, no, a long time ago, not a long time ago.
Yeah,
I
not
would
that
have
long.
thought that.
Yeah.
So, I have bananas upstairs that I bought at the grocery store the other day. Did I finance those?
Yeah. In essence, you did, right? If you didn't use it with somebody, if you didn't buy it with somebody else's money, and I'm not talking about credit cards, and I think that's partly what people think is that I finance everything, and maybe you do use credit cards. That's okay too. It's the idea that whether you're paying for things with your own cash that you've stored and maybe getting a return on, even if it's a small return, you literally are self-financing when you pay cash. So many people don't like to have loans. They'll say, I pay cash for everything.
Mm-hmm.
And
we talked about that in our recent episode.
Yeah, and if you do, it really depends on where you're getting it from. So this concept of, it's really about, there's always sort of a banking function going on, and who's going to be the banker? Is it going to be some outside, lender? A bank, a mortgage company, or an auto insurance finance company, any of that kind of stuff. Or are you going to serve that role? And there's a reason these people are in the business of financing is because they make money doing it. And so you could be the one recapturing what is going to others and building it for yourself. And so to know that first principle that you finance everything because you've lost any ability for that money once you've paid it out to somebody with cash from your own account, from your own bank account or whatever, it's never going to make money, and that doesn't make money. We've talked about this many times, the compounding. And the uninterrupting of it is what we do with the whole life policy. So
I like that verb, the uninterrupting. Yeah, exactly.
Yeah.
Yeah, it's a strange concept because to say that you finance something, and I agree with you, by the way, to say that I financed those bananas. Well, what I really did there is that $2 and I don't know, let's say $2, right?
Yep.
I lost that $2.
Yeah.
Now, and I don't, recommend, I don't say, hey, maybe don't take a policy loan for $2 to buy bananas. But what we all want to strive to be doing, or what John and I strive to be doing and tell our clients to strive is, and Nelson talks about this in the book, is to get to the point where your premiums equal your expenses. That takes a lifetime to get to that point, but always to be striving to get to that point.
Right.
And what moves the needle more is obviously moving towards financing with your own policy larger expenses, ones especially that come with outside interest. But in the example of the banana, that's $2 that is now gone forever.
Mm-hmm.
And we went into this in one of the last episodes, I think the one about, paying cash or borrowing, which one is better. And I gave the example of all the money that my wife and I saved up for the down payment on the house, and then that we spent on furniture and siding and all this stuff, right? And it's, to most people, that probably sounds very impressive. Wow, that's very rigorous financial, saving right there. And it was good. It was good that we were able to do that, but that money is gone forever.
Mm-hmm.
And so there was a lost opportunity cost there, a substantial amount of money that if I had instead known to first put that in a policy, I could have changed the way that I financed my life.
Yep.
And there's a reason that banks choose their primary modality of making money in terms of lending. They're experts at keeping that money within their system.
Mm-hmm. Yeah. Yeah. So I think in terms of, I've got to put it through a banking system. I've got to put my cash through a banking system. And I do have a commercial bank account. It's a credit union, but I use it for transactional, so I can write a check for various things that I have, like rent, and because I don't own a home at the moment, so I write a check to my landlord. I do these things where I use my debit card, I buy bananas or whatever. And so, I get that, but where am I going to put my cash? So let me take an example of a whole life policy and the way that we structure it. And it doesn't mean it's exact, right? But let's just say I have a portion of it where it's required for me to pay that premium, whether I'm paying monthly but I pay them annually, let's just say, and there's a minimum that I have to pay to keep it in force. And then I have an optional amount that I can incrementally put the money in. If I want, I can start with the minimum, and over the year, if I want, I could put in, various amounts, $1,000 a month until I've reached my maximum. And okay, so let's say somebody structures it that way. They only have, they got 20,000 is the max they can put in, 10,000 is the minimum. They pay their 10, and now they've got to, they want to get the other 10 in. But, I can't get it all in at once. Hey, I probably put in $1,000 a month. And then something happens. My car breaks down. I've got take it in, and it's like, oh gosh, right? It's going to cost me $2,000.
The timing belt blew.
Yeah, something happened.
Yeah,
whatever
it was
happened.
the timing belt. For sure. Yeah,
yeah, that did happen to me once. And so I might have the money in the bank. I might have the $2,000, and
I see where you're going with this.
I'm like, okay, I could just send him my mechanic, say, do the work, and I'll take my debit card and give it to him, and he'll take the $2,000. Or I've got this $10,000 that I want to get in to my banking system for the rest of my life.
Mm-hmm.
Which one am I going to choose? Am I going to choose to just have him pull the $2,000 out of my personal credit union bank account, or am I going to take that $2,000 and say, I still have $10,000 to put in. Let me send the $2,000 there, and then I can turn right around and I can borrow it from the life insurance company. But that $2,000 that I just sent to the life insurance company for my optional amount is in there forever.
Right.
And it will compound, and I'm never going to interrupt the compounding of it. But
And
if I
you would
paid
only-
that $2,000 to him straight from my account, it's gone, and I still have the $10,000 that I need to try to get in. Which one are you going to do first? I'm going to put it in my account first, in my policy first. Sorry, account. My policy first, because once it's in there, I never lose it, and it only grows.
And that
Sorry. I know
no.
you've been wanting to say something.
No, I just am like, I very much agree with what you're saying. So that only makes sense to you, though, because you understand the very first principle. Because a lot of people would look at that and they would say, yeah, but I have to then pay interest on the money that I take out of my policy. Right? And so it's this idea of cost without understanding the value that you get. And the value that you get and the cost to you long term is exponentially. It's actually hard to quantify the cost of losing that money for the rest of your life. But it is exponentially higher than you think it is. So that $2,000 compounded at, I don't even want to assign a percentage to it, but a percentage for the rest of your life winds up being tens and tens of thousands of dollars. And then if you are taking further policy loans with that money and making a rate of return with that, you're talking about potentially hundreds of thousands of dollars.
Yeah, it's hard to really put a number on what the benefit is, the return, so to speak. If you want to talk in returns, it's hard to know because it can keep going and going and going if you kept flipping that money over and reusing it and gaining some benefit, financial benefit from it. Yeah, it could be very big. But the idea is I'm going to finance it anyways. And I want to go back to, I was trying to explain something about Brian Bloom's book, The Confessions of a CPA, the capital equivalent of life insurance. And in there, I was using the example in one of our other podcasts of buying a car and what is the true cost. And he just, he took an arbitrary number of earning 5% in an account, but he buys this car for $50,000. And what did that car cost him? Well, he didn't. If he paid cash for the car at $50,000, he's giving up the 5% that year. So you're giving up $2,500, right? Because it's not sitting there earning. But if you were, you do this over time. He went to, the first 5 years of doing this, right? Because you might, if you took a loan, you'd be paying for 5 years. So
that was my last car loan.
Yeah.
5 years.
Okay, so 5 years.
That's pretty standard.
So, he said that the car didn't really actually cost him, $50,000. It costs almost $64,000, and that's partly because of those 5 years of gains, but the gains on the gains. So it's not like you'd think it would be, he made $12,500 because it would be 5 times the 25 a year, right? But of course, each year that number keeps getting bigger. So let me just stop there as I'm looking at the excerpt from the book. He went on to say, okay, if you were, I think the person was, they were 50 years old when they bought that $50,000 car. But what is the cost if at 65 you decide to retire, and what is that cost to your nest egg? So literally 15 years into it, that car cost you $103,000.
That's if you paid cash.
That's if you paid cash,
Yep.
right? Because you lost all that growth.
Yep.
Literally, in your retirement years, you have $103,000, almost $104,000 less to stream out as income. And then he went on to say, what would that be like if you lived to, life expectancy of 85? And what would that be, say, just in death benefit to your heirs? That was $275,000. Okay, so he says, but that's only one vehicle. What are the chances are that from the age of 50 to 85, you're only going to have that one car? You keep losing it every time. And he says, you're using this vehicle to race to work, get to the office, if people are still doing that, whatever they're doing, so that they can then save for their 401k with this car. And literally this car is costing them potentially over $1 million.
Yeah.
In, maybe to their heirs, maybe to your cash flow and retirement. I mean, so that's the idea, is that, whether it be bananas or cars, you're giving up all the future.
And this is whether you actually pull cash from a checking or savings account, or you finance it through like a bank or the car
Ford
place
Motor
or whatever.
Company
Yeah,
whatever.
My last car loan was from Honda.
Oh, okay.
But just this car loan was awesome, by the way. I don't know how I got it. It had 0.09% interest rate, so I just went with it.
Yeah. Quick. But that looks good.
Yeah, that's not usual. But yeah, it's the whole point is that you lose the ability to then compound that money. It's just gone from your system. And we've talked about that many times. And, and that's why we are so adamant about being an honest banker and paying back policy loans, because true, you could not do that. You do have the contractual right not to do that. But the second you lose the ability to then access that pool of money, which you do, if your policy loans are maxed out, you now cannot take advantage of the financing aspect that John and I are talking about.
Yep, well said.
Yeah, so it's really important to keep this going. It can be this unending stream of using the same money over and over and over, and that's what we're really trying to highlight here, and I hope that it's coming across. Rather than spending at one time, and we did finance that, whether we paid cash or not, we financed that through losing interest that we could have earned, which is what he talks about in the book.
Yep.
And instead, if we can focus on a system that allows us to just rinse and repeat the money, it becomes infinite.
Yep. Yeah, like you said at the beginning, some people would say, well, yeah, but now I got to pay interest on the money I just borrowed from the life insurance company.
Well, yeah, why would I go spend extra money, right?
Yep.
Well, it's not understanding the bigger picture. And so that's why John is correct in saying that if you don't understand this idea, the infinite banking concept is not going to make sense to you.
It makes it hard to really, if there was anything that you could lock into your brain, even as a policyholder who's implemented the infinite banking concept, is to, just hold that thought that that's what's happening and what the benefit of paying premiums is, right? Which is that you're always going to be able to have access to that money again. It's not about the 5%, for example, if you're paying a life insurance company, like, hey, I could have paid the $2,000 out of pocket, or I could put the money into my account, then I can borrow it back out, and now I'm paying 5% in whatever amount of time it takes me to pay it. But when I do pay it back, not only, like Nelson talks about in Becoming Your Own Banker, is he says the guaranteed side of the growth of your policy is really the recapturing of the interest. It might not be exact, but it's certainly recapturing some of the interest. Then if, as they have been, they pay the dividends, well, it almost becomes a wash on any interest that you paid, but your growth in your policy is always off a bigger number. If I'm borrowing $50,000 from my life insurance policy to pay for a car, for example, or $2,000 to fix my car, I have a lot more money, or I at least have more money in my cash value that is growing all the time at the same rate. So, am I willing to pay 5% on a year for whatever amount of years on 50,000? And pay $2,500 a year in interest to the insurance company, and I have 100,000 and I'm making 5% on that, so I'm making 5,000. Of course, I'm always going to have a bigger number that I'm growing from. And over time, again, this is doing so much for the present and the future. Whatever that future is, whether it ends up being, sadly, a death benefit to your heirs, or it's your retirement cash flow. And so you want to always find a way to get this money in there because you get to reuse it someday. You don't have to be racing to a job and do a 401k when you already can. You're already utilizing this cash flow in your life, but you keep giving the banking function to somebody else.
Yeah.
And the profits of that banking function to somebody else when you're using your car finance company, you're using a mortgage company. If you had your own pool, of course you would use your own bank, right? Because you get to reuse the money.
And that's the most important thing.
Yeah.
I mean, without a doubt, it is nice, exactly like you say, that the interest rate that is payable to the insurance company is usually very comparable to the total dividend payout. But regardless, the main point there is that you're not losing the money. That's far more important than any of that. And just on a side note of interest rates, the interest rate, on the policy loan that I just took out is a little over 5%, which is great right now. And I think the interest rate on my home equity line of credit, which I'm not using, is 9%.
Really?
Yeah.
Wow.
Yeah, that's the normal spread on. Yeah.
Really? Mm-hmm. Wow. Okay.
Yeah. And if I wanted to get a fixed interest loan, like a personal loan, those are coming in around 8%.
Really?
Yep.
Wow. Okay.
Yeah. So just fun little tidbit there. The interest rates that are payable, are typically to insurance companies when you take a policy loan are typically substantially better, like several points at least below market value that you could get.
Wow.
So
yeah, I'm so stuck in using my policies. I don't even look at some of this stuff sometimes, right? So thank you for sharing that.
Yeah.
Because
I just thought people might find that interesting.
Yeah, for sure. Yep.
Well, that's all I got, John. You got anything else?
No, I think that that's what we're trying to help people understand so that they can, I mean, let's talk. Let's, reach out, ask questions.
If that didn't make sense to you, let us know.
Yeah, this is not about trying to just tell you the way it is. It's definitely a conversation, and it's just, it's helpful to think things through. And I mean, we're not educated on this, so we don't really think about it. We do what everybody does, and because it looks like the obvious thing to do is
it's comfortable.
And it's comfortable. I don't have to really think about it. Everybody's doing it, so that must be the right way to do it. To have to really think sometimes is like, ugh. But this is how I live my life. This is how you live your life, Doug.
Yeah, we're not telling you to do stuff that we don't do ourselves.
Yep.
That's, I think, the most important point there. And we're also not going to tell you anything that we couldn't sit down and factually back up and show you very clearly. So we're not asking you to take outlandish claims on faith. I mean, these are all things that we can show people if they want to see it to help them really understand. So, I mean, John and I take our word and our integrity pretty seriously.
Yeah. Yeah.
Because that's all, I mean, ultimately what we have.
Yep. And sometimes it would be easier to do the conventional stuff because,
Oh, definitely.
right, to sell all the products
Stuff that we don't have to back, we don't have to guarantee, we can make
and
claims that we don't have to stick with.
Yeah, and let other people do all the marketing to assist us and say this is how the world works, and it would just be less going against the grain. And it's not going against the grain because we just enjoy going against the grain. We actually have studied it ourselves and said, this is better for us. This is better for our lives. Yep. And so we're not just, trying to find something different. It's different, and it's proven to be better for us from the way we did things conventionally.
This is far more difficult.
Yeah.
I know I hate to use this word, but this is far more difficult to sell than if we wanted to be, a conventional financial planner or,
totally.
Something like that. It really is. And I know I can speak for you when I say this, that we sleep better at night knowing that we are providing our clients with a solution that we know is going to perform how we tell them it's going to perform, that we don't have to worry about getting that call of like, man, why is my account down 40%? Or why is this doing, it's not based on theory, it's based on fact.
Yep.
And
if you want to do all that stuff, again, of course, we're saying this is the foundation. This is your banking system. Mm-hmm. This is where you go get your financing, and how you do it best. But whatever else you want to do, you should do.
Absolutely.
And I think you probably make better decisions, honestly, because you'll say, do I really want to invest in that? Or do I just want to keep this money around for the next opportunity that I might see is even better, more aligned with how I am and how I think? And so it does make you take pause. And then you're feeling really comfortable that, I can do all these things, and then I'm going to be able to help my children, and I'm going to be able to help grandchildren if I have them. I can help anybody if I want, because I wouldn't have had this money, right? Like, I wouldn't have had it if I didn't put it into this type of policy. Yep. It would have been gone, because that's what we say. You pay cash for something, it's gone.
Yep.
You don't recoup it by paying it back. You don't recoup everything when you buy a house. You don't, you have the house, you may have paid off the mortgage, but you haven't now have access to all that money that you paid. There's no guarantee you do. You might have it, but again, then you got to get the money out of the house, equity-wise, you got to go to a bank. Yeah. Now you got to pay them.
Like we've talked about, I've got a HELOC.
Oh, yeah. So
it was a whole thing.
But so without belaboring this.
No, but it's a good point. And again, I know we've said this a bunch of times. We're not saying that investing in the stock market is bad. I have plenty of money in the stock market. In fact, the policy loan that I took was to exercise an options contract that worked out very well. But the whole point there is that I was able to take that money from my policy to do that, right? But I also understand what I'm doing there, and I think that a large part of the general population is not really investing. They think they're saving, and that's where it gets a little scary. And so, again, like John said, we're talking about setting up a system from which you can do all of those things. So if you like to invest in the stock market, do that. If you like to invest in real estate, do that. You want to start a business, you should do that. Exactly. You want to buy a lake house, you should, do it. It's
exactly.
Yep.
Sounds good. Is that a wrap?
That's a wrap.
All right.
I already forgot we were going to do that. That's a wrap. Thanks, everybody.
Thanks, Scott. Thanks for listening. Bye.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.